Listen up! Today we're talking call spreads, a smarter way to play options. Not just buying calls wildly. This is about defined risk and defined reward. Why use call spreads? To control your bets and protect your capital. This isn't a casino game. It's about making smart money moves. The main purpose: limit your downside and know your max loss from the start. Yes, your profit is capped, but the strategy is cheaper to enter. Think of it as training wheels for winners. Less risk, less cost. That's smart. In the world of options trading, there are two main types of call spreads you'll encounter: bull call and bear call. These strategies are designed to help you take advantage of different market outlooks, whether you expect prices to rise or fall. Understanding when and how to use each can make a big difference in your trading results. A bull call spread is your go-to strategy when you believe a stock is going to move higher, but not necessarily shoot up dramatically. It's a way to profit from a moderate increase in price while keeping your risk in check. To set up a bull call spread, you buy a call option at a lower strike price and simultaneously sell another call at a higher strike price, both with the same expiration date. This combination reduces your upfront cost compared to buying a call alone. If the stock rises moderately, you stand to make a profit, but your gains are capped at the difference between the two strike prices, minus the net premium paid. On the flip side, a bear call spread is used when you expect a stock to either drop in value or remain relatively flat. This strategy lets you benefit from a lack of upward movement. To create a bear call spread, you sell a call option at a lower strike price and buy another call at a higher strike price. The higher strike call acts as insurance, limiting your potential losses if the stock unexpectedly rises. Both bull call and bear call spreads are powerful tools because they limit both your risk and your reward, making them ideal for traders who want defined outcomes. Use a bull call spread when you anticipate a modest price increase and want to control your exposure. Use a bear call spread when you expect the stock to drop slightly or just move sideways and you want to generate income with limited risk. So, whether you're feeling bullish or bearish, pick the right tool for the job, manage your risk, and aim for those profits. Let's see how a bull call spread works in real life and why it's a favorite strategy for investors who want to ride the market wave without taking on unlimited risk. Imagine stock XYZ is currently trading at $50 per share. You've done your research, and you believe the stock is poised to move higher in the coming weeks. You're optimistic, but you don't want to risk too much capital. You think XYZ could climb to $55, but you're not expecting a huge rally beyond that. So, you buy a $50 call option for $3 per share, which totals $300 for one contract. This gives you the right to buy XYZ at $50 no matter how high it goes. To offset some of that cost, you sell a $55 call option for $1 per share, or $100 per contract. This means you're agreeing to sell XYZ at $55 if it gets there. Your net cost for this spread is $2 per share, or $200 total. That's the most you can lose, no matter what happens to the stock. Your risk is capped and defined from the start. If XYZ closes at $55 or higher at expiration, both your $50 and $55 calls are in the money. The $50 call lets you buy at $50, and the $55 call obligates you to sell at $55. The difference between the two strikes is $5 per share, or $500 for the contract. That's the maximum value your spread can reach. Subtract your $200 net cost, and your maximum profit is $300. That's a solid return for a limited risk trade. Your break-even point is $52 per share, the $50 strike plus the $2 net premium you paid. If XYZ finishes at $52, you get your money back. At expiration, if XYZ is exactly at $52, you break even. Any price above $52 means you're making a profit, up to the $55 cap. If the stock drops below $50, both options expire worthless, and you lose your $200 investment. But you knew that risk up front, no surprises. That's the power of a call spread. You get to participate in the upside, limit your downside, and trade with confidence, knowing exactly where you stand. Why not just buy a call? Because it's expensive and risky. If the stock doesn't move, you lose the whole premium. With a call spread, selling the higher strike brings in cash and lowers your cost. Less money at risk, defined loss from the start. No margin calls, no sleepless nights. Sure, profit is capped, but so is your risk. Consistency and confidence win the game. Let's recap the bull call spread on XYZ, a classic option strategy that helps you manage risk while aiming for profit. This strategy is popular among both beginners and experienced traders because it offers a balanced approach to trading in the stock market. Imagine XYZ stock is trading at $50. You decide to buy the $50 call option and simultaneously sell the $55 call option. The net cost for entering this spread is $200, which is the maximum amount you can lose on this trade. This upfront cost is your total risk, making it a defined risk strategy. Now let's look at the possible outcomes. Scenario 1, if XYZ closes below $50 at expiration, both your call options expire worthless. In this case, you lose your initial $200 investment, but nothing more. Your risk is capped. Scenario 2, if XYZ closes above $55, your spread reaches its maximum value of $500. After subtracting your $200 cost, you walk away with a $300 profit. This is the best case scenario for a bull call spread. Scenario 3, what if XYZ closes somewhere between $50 and $55? Let's say it ends at $53. This is where the payoff starts to get interesting. Your $50 call option is now worth $300, while the $55 call you sold expires worthless. You can sell your $50 call for $300, recouping most of your initial investment. Subtract your $200 cost from the $300 value, and you're left with a $100 profit. This shows how the spread can still be profitable even if the stock doesn't reach the highest strike. The break-even point for this trade is $52. Any price above $52 at expiration means you're making money, while anything below results in a loss. Call spreads are powerful because they limit your risk, cost less than buying a single call, and give you a clear plan for every possible outcome. They're a smart way to participate in market moves without risking too much. Don't be a rookie. Learn how spreads work, practice your strategies, and trade smart. With the right knowledge, you can use call spreads to your advantage and make more informed trading decisions.